Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with good friend of the channel, Mr. Jonathan Twomley. How you doing, sir?
I'm doing great, Michael. Every Thursday is a great day for me when I'm here.
That's awesome. Well, hey, I just remember something that you and I were talking about seemingly for 100 weeks in a row were the new unemployment claims. Remember those conversations?
Yeah, yes, I do.
Well, I don't know if you saw it, but it had a record low since 1968, 166,000. So we are now talking record lows, not record highs. So that feels good.
Yes, that is a much better.
That's a much better
to be having than the other way around. Yeah,
so. Absolutely. Well, one of the things I wanted to do here is I don't think there's anybody on the planet that would not agree that inflation is a problem today.
Yeah.
Right. We even have the biggest dove, Lanier Brainerd, now saying we got a problem. Right. So when she's on board with raising rates, all the doves are gone.
And just to clarify who she is, she's on the Fed Board of Governors.
She is the second in charge.
Okay.
She's number 2, right behind Powell. And all the doves, even Mary Daly from San Francisco is a hawk now. I mean, all of them, 9 of them.
Janet Yellen.
Janet Yellen, yeah, she's Treasury Secretary. She's out saying it's a problem. Everybody's saying inflation's a problem.
Yeah.
I mean, they had quotes. What is today? Thursday. On Tuesday, saying inflation is so bad, it's like you don't have a job. I'm like, wow. I mean, wow. That's kind of crazy. So anyways, they're all hawks now.
Yeah.
So I believe there are 3 ways the Fed can beat back inflation. Now that we all agree it's here, and I want to lay them out for you and get your thoughts.
Okay.
So I think there's only 3 ways to do it. Number 1, they could pull out Paul Volcker's playbook and take charge of rates, which means raise more frequently, raise on the weekends. Don't tell anybody they're coming. Just surprise the market out of left field or right field or whatever you want to say it. That is one way they could do it. It would obviously have huge ramifications for the stock market and asset prices, all of it. But we know it works. Paul Volcker proved it. I think we can also say with pretty good confidence that Powell and team won't be doing option 1, but it is an option, right?
Right.
Don't think it'll happen, right?
No, I don't think frankly, inflation is not as bad as it was in the 70s. So it doesn't require the same medicine, I would say.
Okay. All right. So that's one way they could do it. Just they're in charge, take control, more rises on the weekend. Don't tell anybody it's coming. Number 2, I call it the Ben Bernanke route, which is basically clearly as Fed speak is, which is it's always a little murky because they want to have options to get out just in case something happens. But basically at every meeting, tell the market what is coming in the next meeting, right? Clearly articulate, hence the last 2 weeks, that a 50 basis point coming in is in March or in May, excuse me. So tell them what's coming and then deliver what is coming. I think that is probably where they are today. And that is strategy number 2. What do you think?
Well, I'd like to hear what strategy is number 3.
Oh, number 3. Okay. So,
but I do agree with you. I think it's probably where they're going to go. But
number 3, I hear a lot in my comments. I don't agree with them, but I hear them enough. I thought, yeah, maybe. Number 3 is the Fed's going to talk tough. They're going to be the big bully. And then, like lots of bullies, once a fight happens, they run away and they don't do anything. So in this example, the Fed's going to talk tough, 50 basis, 75 basis. We're going to do this. We're going to do that. And then nothing happens. Right. Those are the 3 things that basically they could talk inflation down.
Yeah, I don't think they can talk inflation down without following it up with action, because they'll just very quickly lose credibility and no one will believe them. Right?
Exactly.
So,
that's what I
think that they're their hand is a little bit forced at the moment. So I think what they're going to do is the Bernanke option, which is just, I believe they've been trying this for a long time, right? And COVID sort of screwed, the taper tantrum screwed it up, and then COVID definitely screwed it up. But I think at this point, they really don't have much of a choice. And
they got to get back to even.
Yeah, they've got to get back to what do they call it? The neutral rate of interest, right? So that's, I think, at the very least, they have to get back there. If not,
probably
if not
slightly above,
time
and
to
then
try to rein in inflation, right?
Yeah.
So I just don't see any other option that they've got. I think they will do number 2, until such time as number 1 becomes necessary, if it becomes necessary. Right?
I exactly agree. I think option number 3 is basically what option 3 is, again, talk tough, do nothing, is the buy the dip crowd. That's
Right.
that. And
Yeah.
first off, that strategy has worked amazing the last couple of years. Amazing.
Yeah.
I don't see that working. I think the Fed is like, the Fed told us 2 years ago now, it's been 2 years, that unemployment or full employment was suddenly their number one priority. It was always kind of 1B, and then it was 1A, and we got what we got. They are now telling us that 1B employment, not even looked at. We are only worried about stable prices, and they're going up. So I get enough comments like, you don't understand, the Fed is neutered. They can't do anything. They can't afford the debt. Blah, blah, blah. I'm like, you guys are not paying attention.
Yeah.
It's coming.
I mean, look, and just to be really cynical about it,
Sure.
that, for a long time, and people have made the argument, I think it's somewhat compelling, that the Fed's hands are kind of tied by the size of the federal budget deficit, because
I hear that.
the service on the federal debt, will go up and it'll cripple the government. But I mean,
the math doesn't work. So logically, I hear that all the time. You don't understand, Michael. We got 9 trillion or 30 trillion or whatever it is. They can't take rates up because then they can't service the debt. Folks, all the debt doesn't reset on the same day, right? This whole magically 30 trillion is going to go from 1% to 5%. That's not how it works.
Not just that, they're just going to issue more debt, right?
Exactly.
To pay for the debt before, right? They'll just keep playing the same game.
But they won't even have to do that for years. The math doesn't support it. They could take rates today to 5%. And yes, if you take 5% times 30 trillion, we don't have enough debt, but all the debt doesn't reset Tuesday, what is today? Thursday, April 7th. That's not how the system works, right? They could raise rates to 5%. They can run it for 6 months, and then they could break inflation, and then they could take it to 3, and bingo bango, we're all good. I mean,
and listen, the federal budget deficit is down substantially. It's still huge, but it's
still
also
huge,
down.
but yeah,
It's still huge, and we're still accumulating debt,
Mhm.
but it is down by a lot.
On
So
a percentage basis.
that's helping, right?
Yeah.
So I agree with you. I don't see that as tying the Fed's hands. And frankly,
Not at
I think that the pressure to do something about inflation is greater anyway. And kind of like the federal budget deficit, in a way, it's like the Fed could say that's Congress's problem. Right?
Exactly.
If they don't,
they can always raise taxes and pay that off.
This is a problem. Yeah, they can raise taxes, they can cut spending, they can balance the budget and solve that problem.
That's on Congress
to solve, right?
Exactly.
And if anything, maybe raising interest rates is going to force their hand, right? So,
exactly.
But our responsibility is not to solve the budget deficit.
I agree. Yeah.
It is to keep inflation at bay right now, because employment is not an issue, right?
Yep.
So, so I think that
option 2, right?
Option 2 is where they're going to go, and I think that this time they're also, I think, going to be a lot less sensitive to Wall Street screaming and yelling if it comes to that too.
I totally agree. They're going to there's always, again, the other thing I get is you don't understand, the Fed is in bed with Wall Street. They're going to protect Wall Street, not Main Street. And I would argue that you could probably make that argument, logically speaking, for the last decade or two. No problem. I believe it changed. I believe inflation is so bad, it is hurting the people that least can afford it. I believe they're going to, I don't know if it's quite the middle finger, but maybe to Wall Street saying, hey, sorry, you're going to feel some pain for a while. We've got to get this thing under control.
Yeah, but also they can point at the record profits on Wall Street and say, hey, use equity to finance something for a change.
Yeah,
right?
exactly.
You get all this cash.
Yeah.
So
you're right. Yeah. So the last thing I want to talk about, since I got a couple minutes here, is the Fed. For the first time in my adult life, the Fed is actually going to be impacting not only the front end, which they've done all the time with the funds rate, right? This is that whole, let's raise 25 or 50 basis points, but their balance sheet, $9 trillion, roughly 65% treasuries, 35% mortgage-backed securities. They now, because they're going to be reducing their balance sheet, will also impact the long end. And I don't think people are realizing this. I actually said it a couple of days ago when the yield curve inverted. I said, just wait until they start selling. The yield curve will not be inverted because, again, they're going to impact. So, again, I think the Fed has a new tool. They've allowed their balance sheet to get so big that they now can play with the long end as well. Do you see it that way?
I mean, I never thought of that before, but I mean, it stands to reason, right? If they have the ability to move the markets by selling, they've got that much stuff to sell.
Yeah.
They can definitely, keep Wall Street from fighting the interest rate hikes, right? So yeah, very interesting point.
Yeah, they're going to be playing with both sides of the curve. And again, I don't expect the yield curve to invert again, because they will just play with, they will throttle how much they're selling.
Yeah. And it's sort of, and just back to the point about the price discovery being gone.
Mm-hmm.
It's interesting how this also just shows that the whole yield curve inversion tool is kind of irrelevant under these circumstances.
Agreed.
Right? Because both ends of it, because it used to, when rates were not so heavily manipulated by the Fed and other central banks, right? Mm-hmm. And it was more, they had a neutral rate of interest, or tried to, and then interest rates were set by market forces.
Correct.
Then it meant something.
Yeah.
Right? But when it's simply like, well, okay, now the Fed can just drive down the long term, or drive up the long-term rate too, or drive it down, whatever direction it wants to go, and it can just cause the inversion to reverse, then it doesn't mean anything anymore, right? So
yeah, it doesn't mean anything.
Yeah. So all the people saying, we got the cross, the death cross, like it's just.
This time, the pandemic, the $9 trillion, the free money, modern monetary theory, all this stuff that was tried, helicopter money, it has caused the old rules not to apply.
And just one more point on this, the long end.
Yep.
I know there are going to be people who are going to be like, well, what if nobody buys the debt? It's going to make interest rates go higher.
Exactly. Right? There will be a buyer at some price.
Right. So yes, exactly. And the higher the interest rates go, and then you just turn back to the conversation we had a couple minutes ago.
Exactly.
About when you've got insurance companies who are saying, are we going to take on the headache of buying commercial property, or are we going to just buy treasuries?
Yeah.
They're just going to buy the treasuries if they're
absolutely
3%. Right?
And let's not forget the rest of the world, right? Europe and Asia predominantly still have negative rates. You don't think they want to make 3 or 4%? Are you kidding me? Come on. It's crazy. Jonathan, how can people find you?
They can find me on many different places, but one way, if you would like to invest with me, is to Google my company, Two Bridges Asset Management, and fill out the investor form if you are accredited, and get on my investor list. You can also go, if you would like to not invest with me, but you would like to learn how to become someone like me who does investments and gets investor money and all that kind of stuff. I have a whole suite of courses and monthly calls and all sorts of stuff that you can participate in if you go to multifamilylaunchpad.org/join. And finally, if you just want to participate in the conversation with me for free, you can go to the Multifamily Investment Community on Facebook, sign up there, and join 12,000 of my closest friends, and
including me, I'm there.
Talk about multifamily. Yes.
There you go. Thanks, Jonathan.
Absolutely.